Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Jake Stenziano, doing good. How you doing, bro?
Always making it happen, big man. Today's guest is Christopher Urso. Christopher is managing partner of Urso Capital. Since 2007, he has helped the firm accumulate over 1,800 units with asset values over $100 million. Christopher is responsible for leading the company's mission of acquiring well-positioned multifamily assets in need of turnaround while maintaining a risk-aware approach in today's market. So without further ado, Christopher, welcome to the show.
Hey guys, thanks for having me. Appreciate
Morning,
it.
Chris.
Good morning.
Let's get this thing kicked off. Tell us about your real estate background and how you got started.
Sure. Do not come from a real estate family. Had no real estate experience whatsoever prior to buying our first deal. My wife and I read a book, Rich Dad, Poor Dad. I'm sure you guys have heard of it. Right when we got out of college, back in 2000, somebody handed me the book. I read it 3 times, commuting to and from the city from my parents' basement. And we gravitated towards real estate, started talking to people. And at 21 years old, we bought a 2-family rental property in beautiful Paterson, New Jersey. And that started it off. We learned the basics of cash flow from that. I was making $800 a month in living in my parents' basement, making $800 a month off of this rental property. And we did a bunch of deals on the side for 4 or 5 years while we were working full time, and then made the move over full time in 2008.
Jake, it's funny. Urso, Italian last name, Barbaro, Italian last name, living in parents' basement. It's like a recurring theme of my life. I meet a lot of guys who have my story. The mom's basement, dude, it's great, right? That is cash flow 101. Right after college, I moved right into the basement. Before I got married, moved into the basement. After I was married, building a house. That is the way to build cash flow, Chris. That's just hilarious. I love hearing that story. Why real estate, though? Why did you choose real estate?
So why real estate? I mean, from reading the book, my dad worked for the New York Times from when he was 16 to when he retired at 65. So all I knew was him waking up every day, taking the train to and from the city. Did this for practically 50 years. I never went without. We were the typical prototype middle-class family. My mom managed the budget as tight as could possibly be. Never went without, but my wife and I are mutually aligned, and we wanted more. Like, we were driven. Her dad was an entrepreneur, not a real estate guy, but built businesses. And we read the book, and honestly, we gravitated towards it. The tangibleness of it. I like being able to create things. I'm not the handiest guy at all. I can't hang a picture, but I have really good vision for this stuff. And, obviously the cash flow and the wealth appreciation over time was really what drew us to it.
So I know the answer to the question, but I want to ask you, what did your parents say once they heard you were going into real estate after getting a 4-year degree at Manhattan College and all? What was that answer? What was that? What did that look like?
So, believe it or not, just the way I bought my first house, I had to convince my parents not to pay off my student loans from college as my graduation present and give me the money instead. So I'll never forget sitting at their dining room table and explaining to them at 21 years old, they saved and worked their butt off for me to not have any college debt coming out of school. And I'm saying, no, listen, give me the $25,000. I'm going to go put it down in this 2-family, and I'll pay the $179 a month. And it turned into, oh my God, what if the tenants, slip and fall? What if the house burns down? What if they don't pay their rent? And I said, what if I get hit by a bus tomorrow? And they said, all right, if this is what you want to do, we're behind you 100%. And now fast forward, my mother loves sitting at cards and telling all of her friends that, oh, I own this apartment building with my son. I own this apartment building. So,
Does she tell you now, Chris, can you take me to these places? I'd love to see these places. It's like from the no to like now, hey, it was my idea, right, Chris?
Yeah,
I'm glad I pushed you into it.
It was a lot of fun. We took the whole family down to Charleston about 2 years ago, and we rented a big bus, and we took everybody around to the properties. And, of course, it was our proud mom moment. But
let's dive into that first deal. Why did you choose Paterson? I mean, the great thing about what you're doing, Paterson, people understand the rich dad. You're buying an asset, an appreciating asset. You're paying off debt with that appreciating asset. At the end of the time, that asset is appreciating in value while your debt's going down, and you still have something at the end of the time. People can't figure out that concept. At 21 years old, for you to understand that and actually make it work is awesome. But can you go into that first deal and what happened to it? Did you ever end up selling it, or you still have it?
No, I mean, that was a pivotal moment. I mean, that was back in 2001. So we were really, really lucky. Timing's everything, right? In real estate, it's hard work, timing, and taking action. all comes together. But, we were able to get into real estate before there was a crazy run up in residential real estate. So we had to focus on just fundamentals. Like the numbers have to make sense of the deal. It's not, buy it today, sell it 5 years from now at more money. How are you going to get there? And what's it going to do for you in between? And that deal really set the stage for us to be, kind of cognizant of fundamentals on every deal that we've done since then. We were really lucky. We had great people. We focused on people. I didn't know anything. Patterson's the heroin capital of the United States. So it's not like it's this big emerging market, but I talked to a lot of people, and they said, hey, talk to this guy, Mike. They're buying up a lot of properties from the county, and they're renovating them. They're putting Section 8 tenants in there. They have all the pieces in place. So Lisa and I went out there for 6 months straight every weekend with a massive hangover at 21 years old, drove out over the GW and said, all right. And then finally they came to us and said, hey, we got one for you. We'll help you through the whole process. We'll get it set up with tenants. We'll help you on the financing, and we'll help you manage it, whatever you need. And we just took action at the end of the day. And we were fortunate that we got in at the right time. We ended up selling the property for like $100,000 more than we bought it in a matter of 3 to 4 years because the market started going crazy. And that really gave us a springboard for momentum.
What was your next deal?
We ended up doing 3 more deals in Patterson. So once I learned the process, they were buying them, renovating them, renting them. I then went out and said, I want to find one before it's renovated. So I got a crazy young realtor to run around town, called me up one day and said, you're never going to believe this. The bank accepted your offer. What are we going to do? He says to me. The kid was young, probably never did a deal before. I go, what do you mean? We're going to buy it. He goes, you got money for it? I was like, no, but I'll get the money. So I went to the guys who sold me my house that I bought and said, hey, I got a great deal. And they said, all right, we'll give you all the money. We'll split everything 50-50. And then that's how it went from there.
So let's talk about those deals in Patterson to where you are today. How has your investment strategy changed? What are your parameters to buy nowadays, and how has it just all evolved into today?
I mean, the big change for us was 2007. The company I was with in the city, which was not a real estate company, it was a startup a buddy of mine had. Another really glamorous business, document management, and litigation support. My dad thought I worked at a copy company for 7 years, pretty much. That company had sold in 2007, and I had a sliver of equity in it. So between that and some of the deals we've done, we'd accumulate some cash, and it was either get into real estate full-time or, stay the course in corporate America. And my wife had gotten her master's in real estate from NYU, so we made the decision to push our chips in 08 as the world was imploding, which in theory was great, phenomenal. Bear Stearns, Bernie Madoff, everything else popping up. But we did residential real estate, excuse me, for 2 years. And, I know we'll probably discuss, but, that was probably our biggest mistake, is we stayed in the space that we were comfortable in when we went in full time. And for 2 years, we bought about 60 houses across 5 states. And then we transitioned over to multifamily in 2010. And now we've progressed into, 140, 150 units and up, $10 to $30 million, real heavy value add investors. We like to get really dirty and, buy properties that have significant, capital needs or operational needs.
How did you start buying those properties, those single families in the States? How did you choose those actually, the markets themselves, and were you managing them yourselves, or how did that whole process work out in the beginning?
It really taught us a lot about the importance of knowing your markets. So Lisa and I have constantly been, personal development, wealth building, life coaches, whatever you want to call it. So we had joined a wealth building community, met some guys from Cincinnati, went down there because 2008 there was no financing. So I only had a small amount of cash. And in New York, you guys know, all right, I could go buy a 2-family for $300,000, even in a distressed situation in a decent neighborhood. So that would have been my one deal. I would have been done. So I needed to move. I needed to be able to move. So we looked for these markets that had lower barriers to entry and more stability. While everything was really imploding around us, these markets kind of were just chugging along. They didn't really go up a lot. They don't go down a lot. That's what brought us to Cincinnati, solid, diverse employment base. And we stayed there for about a year. Then we branched out into Nashville, parts of Pennsylvania, and we assembled little local teams. A management company that had to have rehab capacity, and we replicated that in a couple of markets. And then after realizing, the good old quote, right? definition of insanity. You keep doing the same thing over and over and over again and expect a different result. You're insane. So after doing 60 of them and still not getting any bigger, really at the end of the day, just getting more headaches, is when we made that transition. We used a lot of the same people that we started with and said, only show us multifamily properties now. And we started small. We started with a vacant 40-unit building for $260,000 in Cincinnati.
And what did you do with the single families? Do you still own that portfolio? Or did you sell them off?
No, we sold them all off. Never. We went to our favorite restaurant when we sold our last one and lost $25,000. It was the best celebration we've had, I think.
So this is all about multifamily. We love to really dive into multifamily. You're the perfect example. Why multifamily and why not single family? Convince me. I don't need to be convinced. Everyone listening needs to be convinced.
The biggest thing, whether you're a passive investor or you're going to be active, is the scalability of it. The economy is a scale. I did one deal I focused on was 40 units. It took me 2 years to get to 60 units. And the biggest reason for me, and the best advice I got was from our coach at the time, was since unfortunately passed away, a gentleman by the name of Will Maddox. He said to me, "What's your ultimate goals, Chris?" And I said, "I want to build $100 million of assets under management." And he goes, "All right, take a pen and paper." He said, "Your average home that you're buying right now, fully stabilized, is about $50,000. And he goes, "To do that, you would need to do 2,000 homes." And I almost fell out of my chair because I was like, 2 years, I can't work any harder. I did 60 houses. He said, you need to focus on larger deals. It's the same space you're in. It's residential housing. You will get much more economies of scale. And that to me is the biggest thing. It's safer to be investing in or buying a 50 to 300 unit complex versus buying a single family rental in a random market in the United States. I always tell people hey, I can tell you this because I did it, right? I'm not telling you not to go buy that turnkey cash flow house for $50,000 and only invest with me. I'm telling you, don't go buy that house for $50,000. Look at your other options. See if there's other sponsors like yourselves, like us, dozens of other groups out there that you can take that $50,000 and invest in a larger deal or $100,000 and get the same results that you would get by owning that one single rental where if something goes wrong, your management company goes away, you're only one little house. Your tenant goes away, you have no income. I mean, it burns me because we've been there to see all these guys. I mean, people are selling homes on the internet like they're a piece of stock. And selling to people in their IRAs, these people have never owned real estate before, and they think that they can go buy one house, two houses in middle of nowhere USA, and they're going to make 12% the rest of their life. They don't realize when you have that one turn on a 4-bedroom, 2-bath, Section 8 rental, that turn is going to cost you $5,000, and your cash flow you just made for the last year, 2 years is gone. And I did that, so that's why I can get so angry about it.
Mm-hmm.
GFIs or single-family homes? You guys are going to get the nuts here.
Don't get me started, man. Never buy a 4-bedroom, 2-bath, Section 8 rental property. That's all I can tell.
Well, I agree with you. There's a lot. There's two takeaways, Jake, in what he just said. The first thing is he's got a life coach. See that, Jake? It's all about setting goals and getting priorities. And the second thing is the exit in mind. People get into real estate without having an exit strategy, without knowing what they want to do. He hit $100 million. Maybe he should have said $500 million because he probably would have gotten $500 million. He's at $100 million now. Now he can revise it upward. So everyone listening, life coaching is vital for your success. 96% of the people who get out of college don't have written goals. And guess what? Only 4% of the population more or less actually end up financially free when they retire. So what does that tell you? The vast majority of people who write down their goals and get their stuff together and know what they want in life are the ones who succeed. And we're just talking to one today. So I'm glad you said that. It's vital. It's vital for your success. It's vital for our success. You have to know why you're getting into it. And real estate is not passive. If you're not running it, someone else has to run it for you. You have to mind the ship. We had a podcast with Chris Memphis, Chris Close, I'm sorry, from Close. Yeah. His model is awesome. It's the single-family model, but it's an awesome model because he doesn't buy the type of house you're talking about. He buys a stable asset in a stable, and he's got his whole systems in place. He bought 700 homes. So for you to do that, you've really got to have a real, true business. So, the majority of them don't do what Chris does, and they do what you did and what Jake and I started to do in the beginning. So I just wanted to, differentiate that whole difference.
I agree. And when people say to me, I want to do that, I want to own my own, they're probably one of the three groups that I actually say, say, then go find these guys, because that's all that they do. They have it down. I agree. It's the one-offs that scare the hell out of me when you get a guy from New York or California that says, "Oh, it's a $50,000 house. How could I go wrong?" That's famous last words.
And then the problem, Chris, what ends up happening is you get those limiting beliefs because you crap out on that one deal, and then all of a sudden real estate's risky. It's not risky. You're the risky one who didn't spend a year or 2 years and a couple grand on your education to figure out how to do this. Which is great. You jump in and you try it, but then after you crap out the first time, you're like, that's it, I'm done. And you poison the well for everybody else, for a lot of people trying to get in. So, let me ask you, how has your investment strategy changed over the last 5 years as this market is escalating? How do you choose a market? What do you look at a market, and what are your parameters, like cash on cash and cap rates and all that?
Sure. So markets, I would say, are probably our number one thing that we focus on. We've always taken that top-down approach to investing because we're not in a position where we're running a $500 million fund and we just got to slam 20 deals a year. We're looking to do 3 to 4 deals in a given year that are really, really good deals. So we want to know the areas that we invest in first and foremost. I mean, we're focused on the Southeast and the Midwest. We've now gotten regionally. Early on, it was literally one city, learn it, know it intimately, buy some deals there, then move to the next city. Learn it, know it intimately, build relationships, then move to the next city. If it wasn't in one of those cities, the deals coming to me, I wouldn't look at them, because I don't know that market well enough. So the markets we're focusing on, Carolinas, Georgia, parts of Florida, Ohio, and Kentucky. If it's not in those wheelhouses, we don't look at it. My wife will come in and press delete if she sees me starting to stray and look at a deal in Boise, Idaho, or parts of Texas even that are great markets, but we don't know. So markets first and foremost. I'd say over the last 5 years we've expanded to more regional based than individual city based because our relationships now are a lot of overlapping relationships. And we know those areas very well. Deal-wise, we've come up the ladder on size. I think that's the biggest thing. We did the whole $1 to $5 million deals early on. Then we went from 2 to 7, from 5 to 10. Now we're really trying to hit a benchmark of a $10 to $30 million deal size to support the office, the scalability of it. It's no different, as we all learn once you get a little confidence after doing 150, 200, 300 unit complex. You realize it's all the same. So size is really important to us in terms of deal size and also, unit count. The little ones are tough, like that 100 unit. It's tough. You lose 3-4 residents, that's 3-4% of your occupancy. 200 units, you don't really feel it if you have a little hiccup. And then return parameters, we're value add buyers. When brokers sit there and say, what's your cap rate? I tell them I'm not a cap rate buyer. We're not the guy that's going to look to buy a deal and just operate it as is, for the next 10 years. We need to be able to sink our teeth into something today that we can quantify and say, we can change this or do this better or fix this to get to a certain return threshold. So after doing our value add programs, we want to be able to hit, a stabilized cash yield between 8 to 10% plus to build off of. And then from a deal perspective, we're looking to be in the mid to high teens from an IRR level as our benchmark minimum for our deals. Depending on the risk profile, that's going to go up the ladder, obviously. And keep in mind, some of the deals we do, they're not all yes, we buy the vacant property, but we also buy the property that's 93, 94% occupied, but we see something broken in operations, whether it's concessions or an inexperienced operator or lack of amenity package that we can then kind of play a momentum game on and dovetail off of previous ownership. But there's got to be something. We can't buy that 2008 vintage deal that is at a 5.25 cap that we're going to put 10-year money on and just hold for 10 years. I don't have that kind of money behind me to do that, and nor do I have the desire to do that at this stage of my life. I want to get. Let me ask,
what do you consider value adds? What kind of value do you specifically hone in on, other than the amenity package? I love that. A little dog park, a fitness center, clubhouse. What other amenities or value adds do you focus in on?
I mean, we're big on understanding the floor plans of the properties that we're buying in their underlying submarkets and looking to see any opportunity to add washer-dryer connections if they're not there at an economical level. We're doing, we just closed on a vacant 140-unit property. So that's getting a $30,000 unit renovation, $4 million renovation. So roof, siding, windows, brand new kitchens, granite flooring, everything is getting done. Plumbing fixtures. We've done jobs where we've taken something that's 100% occupied with Section 8, turned them over 100% of the units, reskinned the kitchens, bathrooms. We've put pools in properties. We've added fitness structures, fitness centers. But to your point, we're focused on, we do a lot of outside in. So we'll buy certain properties. It's not about upgrading. It's just fixing stuff that's broken to get them to market levels. And then if the location demands it, we'll do the upgrade package on other properties.
What type of assets do you focus on? Do you like B assets, C assets, and type of neighborhoods? What do you focus on?
We won't do is the C and the C anymore. It's not our strength. Just to buy a straight up C deal in a C neighborhood with no compelling upside to it. What we're trying to buy is true C to B stuff. If it's in a B space, we want all original. Right now we want what everybody wants out there, right? It's the 80s vintage, unrenovated, product in a solid workforce plus location. But again, we'll buy the really banged up 70s product and not be scared to put $20,000 a unit into a deal if we believe that the delta between the Class A rents and where we want to take it to a B level is large enough.
So when you talk about that, what markets really are ripe for that? Because we're seeing problems. A lot of guys come in and they're doing those $10,000 per door renovations, and they're getting the 3% rent bump. I just don't understand how those work. It's crazy. Jake and I are up against that all the time, and they're called light value adds now. Yeah. What the hell is a light value add? You know what I'm saying?
Well, every deal
we've already done the work, and we want to sell it anyways.
Every deal's a value add that's out there today. Hands down. You can come in and put brushed nickel doorknobs on, and you can get $25 a month for it. We don't look at that stuff either. It's not the light stuff, but we like the markets with a little bit higher barrier to entry and higher price points right now. We started off in the Midwest at the lower price points, and we still own there, and we'll continue to buy there. But you look at markets like Charleston, like Savannah, like inside the Beltline in Atlanta, inside 285. In Atlanta, where your B product rents will be north of $1 a square foot. So we're looking to buy those C deals that maybe haven't been touched, that are hovering in the 70s, where we can bridge that 20 to 30 cents square foot delta, with the right renovation combination. Mm-hmm. We sold out of Jacksonville, but I think that market has a tremendous runway ahead of it. What scares me there is just like Atlanta, the vastness of the geography. And, markets like Savannah and Charleston are very boutique markets. They're very hard to get into. But once you're in there, you got natural barriers. You got high barriers to entry there. Not as easy to go slap up, garden style apartments in perpetuity. We love Louisville. We just bought a deal downtown Louisville a couple of months ago to kind of just get an anchor in downtown, a little bit smaller than we want to do, but it was a strategic move. Good opportunity to get into downtown. Again, a little higher rent. You're talking about walking into rents at 95 cents a square foot that you can take to $1.10, $1.20, and still be well below Class A rents in downtown.
That's great. That's awesome. I want to circle back on that 100-unit deal you did. Tell me, how and why you bought it. I know you bought it right. You bought it a few years ago. But what did you learn from that first big deal?
So that was a big milestone for us. The 3 deals prior to that were all sub 100 units that we had to buy for cash. So we raised 100% of the cash from friends and family for our first 3 deals. The biggest milestone there on that deal was that we were able to get Fannie Mae financing. So it gave us a level of confidence that we were financeable. We were able to go through that process successfully. I think what we learned on that is, it's buyer beware for sure in this business. So the 3 deals prior that we bought were all distressed deals. So it wasn't so much focus on in-place operations. They were highly distressed bank deals. So in-place numbers didn't even matter. It was all about where we were going. This particular deal, we were buying thinking that, hey, we're coming into this with a good, stable, clean operations. Financials looked great. We were buying from a seasoned professional. We got in there, not even 30 days in, all of a sudden we have 12 evictions in process. And on a 100-unit property, that's 12% of your occupancy. And we were like, what the heck is going on here? The financials didn't show this. So there's different reports in our business that now we have a, no stone uncovered mentality ever since then, on the deals that we buy. And I think it really taught us that we're value add buyers at heart. There was no big compelling value add. The whole idea was to come in and just operate this deal as a workforce housing product and, not really change it for better or worse. And that's just not who we are. It doesn't fit in line with kind of our culture, our passion, and our ultimate vision. Now, again, buying right saves your ass, pardon my language, saves you in this business. We all know that you make your money on the buy, and that kind of protected us. We underwrote it very strictly on the front end. So we'll do all right. We're going to hit a single. We're not going to hit a triple. But most importantly, we're not losing money.
Chris, Jake and I came up against the same thing a couple of weeks ago. We're looking at a deal in Memphis, a very large deal. And I didn't really understand the term at the time, but the physical occupancy was high 90s. Mm-hmm. The economic occupancy was mid 70s. So how do you guard against that now? Because, they make it look great. The pro forma is great. When you look at the numbers, it's like these numbers don't even make any sense. These guys are asking for a number. It's not even worth the debt that this thing is written on. And they're telling me that the bank has actually had 2 deals for a couple $1 million more, and they said no to it. And I'm thinking to myself, if they said no, it doesn't make any sense to me. So how do you actually figure out the difference between physical and economic?
Yeah, since that deal, that is a priority for us. Up until the last deal we closed in Savannah was a huge deal, $21 million deal. The day of closing, I stopped the closing because we uncovered that they were carrying $22,000 of bad debt that didn't show up anywhere. I uncovered it because our teams push for age delinquency reports. There's age delinquency, there's regular delinquency reports. So we've been pushing for an age delinquency report, which goes back and shows, past due balances 0 to 30, 30 to 60, and 60 to 90. We got the updated report day of closing. There was $22,000 on there that was never written off on the financials. We got a $75,000 discount literally an hour before we closed because I would not close. That's how sensitive we are to that. So it's really being super thorough on your file audits, super thorough on your reports, and digging and digging and digging. Not just taking the financials, but getting all the supporting reports to understand how the financials are being run. And that age delinquency report tells the whole story of a property.
Can you dive into a couple more due diligence things that you look at while you're actually inspecting a property, going down the property?
We're in a very good place now from a management perspective, but, we bring anywhere from 12 to 14 people are on a property for 2 to 2.5 days. And that's usually 3 walk teams. So every unit is a must have for us. We don't do 20% of the units, 50% of the units. You go in 100% of the units. We do extensive file audits. So every single file is gone through. We do a concession audit. We're checking other income, verifying it. We're getting bank statements. Bank statements are very difficult. It's not like you're going to be able to tick and tie each resident's deposit. But again, to protect us from what we learned on that first 100-unit deal, we want to make sure that those total bank deposits are somewhere, give or take, within 5% of what's on the financials, month over month. So we want to see if they're saying there's $100,000 of income in August, I want to see close to $100,000 of bank deposits for August. I don't need to tick and tie each one of those. I'm looking at the global picture and seeing if that matches up. I think that's a big piece not many people, especially newer investors, will spend their time on. But that's something we do hands down on every deal. And then we have a separate team that looks at all the major capitals. Your roofs, your windows, your parking lots, your mechanical audits, your appliance audits to understand life expectancy. So it's a pretty comprehensive approach.
I've always liked the bank statements too. I think the bank statements are just simple cash basis. Let's really see what's going into the account, and I've always been a fan of that as well. It's not going to tie to the accrual on the monthly, but it's a good way to see what's really happening now.
It just gives you that, and real estate taxes is another big one, understanding where your real estate taxes are going to go post-closing.
So we deal with a lot of mom and pop owners, and let's say Gino's out there. I found a 22-unit deal. Mom and pop have everything scratched on a paper. You can't find out. What do you tell them to do? What is your advice for that? Because they're dying to get into this deal. It's definitely value add. They're co-mingling funds and all. What have you done on deals like that to actually protect yourself?
Those are so exciting, those deals, first of all. Whenever you get financials like on a piece of paper or a notebook, it's like all of us that are deal junkies, your antennas just go nuts. You start drooling. That's where you really, really need to understand your fixed expenses. All we focus on is the fixed expenses, knowing them well, and I throw everything else out the window, and I try to verify income first and foremost through leases. If there's no leases, you got to get estoppel certificates to protect yourself. Get the in-place tenants to sign off and say, this is their rent, this is their deposit. I attest to that, I certify that prior to closing. Because otherwise, you're going to get in there and close, and that tenant's going to say, "Oh no, I don't pay $1,000 a month. I pay $500 a month. I have no leases here." So we focus on the fixed expenses, understand your utilities, taxes, insurance, verify your income, and then it's all pro forma operations from there.
Yeah, Chris, I wish I had known you 4 years ago, because our first deal, we had to go knocking door to door to find out what the rents were.
Yeah.
It was they had weekly renters, so we were just like, please have a heartbeat in there, So it was a real big learning lesson.
Not only that, so we were like, what the hell do we do? And that's what my uncle told me. He said, go to the door and knock and say, can I verify your rent? And the scariest part about this, Chris, is I get to the door, and there was this little old lady. There's a 25-unit deal. It was our first deal. This guy opens the door. We were going to ask him how much he was paying in rent. And I told this on another podcast. He had a hole in his boxers about this big, and it was out there for the world to see. I'm standing there with this little old lady as we're going through this, and we said, you know what? You're good, bro. Go ahead.
You're free this month.
Yeah, no, we'll check. We'll give you that one, all right?
Worked it out. Here's a new pair of boxers, by the way, too.
It was that one's burned in my memory. That's not a good one, so.
We see a lot of interesting stuff in this business.
That's for sure.
Let me say, I got one thing to say. You're really lucky. You're really fortunate to be working with your wife. That's an amazing thing. I've had the ability to work with my wife in my previous business. I want to have her jump on board. Now I've got my kids growing up, and I want to get them into the business. How have you been able to scale your team as you've been growing? How have you been able to actually implement a team around you?
I think that's probably one of the most overlooked factors in real estate. Everybody thinks it's a physical business. This is a people business, 150%. From the front end of acquisitions to on the ground day over day on operations and management. We've been, it's been a tough ride. We're grinders. We've gone through two partners. We hit a certain period where, I kind of was at a point where I was in the search of, we need this type of person. We need this type of person. But we've been fortunate enough to kind of figure things out over the years. We've had amazing people that are with us now. My wife is kind of the CFO capacity. She's operations post-close, more front-end capital development, acquisitions. And we have an amazing young analyst that, we actually coached early on, and he did 3 or 4 of his own deals at 25, 26 years old. And then we brought him on board to be basically our, lead analyst in-house. And we have Maria, who's been with us from day one. It was me and her in my spare bedroom in the house 7 years ago, starting this as our kind of office manager and keeping all the pieces going. And Rebecca now is our kind of marketing, investor relations, person who does a phenomenal job just creating a huge experience for our investors. So it's like we got everybody in our lanes. It takes time. So internally we don't have a complicated business. You guys know that, right? There's maybe 4 buckets that run our business, and it's getting the right people in those lanes. And one of the best things that I ever learned was The One Thing by Gary Keller. If you've never read it, read the book. Guy who started Keller Williams. It's really fantastic. And then on operations, we use third-party management. We always have. That was probably one of the biggest challenges once you start going into multi-cities and in the smaller deals. Because usually the guys who are going to manage a 40 or gals that are going to manage a 40 or 50 unit building are going to do that in their one city. They're not going to do that in 5 or 6 cities throughout a region. Mm-hmm. So at one point early on, we had 5 management companies for 7 deals, which was really tough. So again, another reason for going larger on deal size. You're just getting that higher level of professionalism that have more critical mass that you can tap into, more resources that you can tap into. And now we have one management company across now 5 states for our entire portfolio, and we can grow with them in perpetuity with the markets that they cover. So that's been a huge milestone in terms of our team that we can tap into, is to be able to do that.
So let me ask real quick about a management company. What do you look for in a management company?
Now, after learning what not to look for, I think the important thing is that they're not too big and not too small, for where you are at any given point, right? So we've taken the approach over the last few years with all of our professionals, whether it's attorneys, accountants, management, we want to be able to grow into them, not outgrow them too quickly. We're looking 10 years out and saying, is this going to be the same accounting firm that we'd want to use when we are a $500 million plus company? Can they handle that? If the answer is not yes, then we have to make a very uncomfortable decision because they've been good to us and make that move. The same goes with management. If they can't grow with us in the future or we can't grow into them, then they're probably not the right fit for us today. If they're not willing to take a little bit of a leap of faith to do something that might be a little bit smaller for them today and make an investment in us, we're not going to make an investment in them. And it's responsiveness and communication. We demand on every property that we have that there is a standing weekly call. There is not one deal that we have, no matter how stable it is and easy it is, that we don't talk to our site team and our regional every single week. And they're required to report to us on all the key metrics every single week. And infrastructure. So there's a lot on the management side. So we're able to tap into a management team that has a national marketing director, a regional marketing director, a national facilities manager, regional facilities manager. So I don't have to. I have what I need in my office right now to grow to 5,000, 10,000 units because of their depth inside their management company.
I like that. Well, let me ask you, what's your best real estate investing tip that you have for the listeners?
Focus. Don't be a shiny object chaser. Whether you're a passive investor or an active investor. We all know with the internet out there today and all these real estate club meetings that every month it's flip this, flip that, buy this note, short sell this, back flip this, and retire on a beach, and life is easy. Focus. Understand what you're trying to achieve from your real estate investments, and then focus on the strategies that are going to only meet those goals. Don't focus on anything else. Don't try to just grab at this, grab it. There's nothing easy. There's nothing fast. This is the best get rich slow scheme out there, real estate. There is no overnight do one deal and you're done. But focus, I think, is probably the best advice I can give someone.
The best get rich slow scheme. Quoted. Yeah. I like that.
That's the title of this podcast, Jake. You got it.
The best get rich slow scheme. I like it.
You're going to have 2 people listening to it if you put that title up, though. Right?
Yeah, exactly.
No beach. Yeah, no yacht just yet.
That in the fine print.
I really I liked earlier when you said that you're a self-development guy. And so I'd like you to tell us about your best daily habit that makes you successful.
I think for the last probably year and a half, one of the best things has been, I don't know if you guys have heard of TM, Transcendental Meditation. Mm-hmm. So look it up. I mean, it's become a lot more popular in Main Street. It's been out forever, but it's basically just unplugging, trying to do your best to unplug for 20 minutes a day, twice a day, and literally just go dark. No mantras, no nothing. The whole basis of it is to completely get your place and get your mind into a place of complete darkness, where you're not focusing on anything and just unplugging. It's a way for you to end. The whole idea is that you're getting all these thoughts that, millions of thoughts that are going through your head every day. You're getting them out during those 20 minutes so they're not clouding the rest of your day. That's probably one of the biggest things that we try to do our best on and incorporate into our lifestyle, both for business and personal benefits on a daily basis.
So what do you do? Just kind of lay down and close your eyes for 20 minutes and just try to relax?
It's much deeper than that when you look at it. There's you got to go to 4 or 5 days.
That's a whole nother podcast.
Yeah. But guys like Ray Dalio, Jerry Seinfeld, Oprah Winfrey, they've kind of brought it mainstream. They've been doing this for 20, 30 years consistently. And it's been probably one of the most impactful things.
Well, it's more relevant now because we've got so many devices going on. We've got LinkedIn, we've got Facebook. Yeah, Instagram is the worst. I can't figure a lot of these sites out, and their time sucks. And that's the problem. People waste so much time on them. They're not really proficient, and it's unfortunate that we have to do that now because if you don't do that, you don't unplug. And even if you have children, it's probably a good thing to do with your kids. Just unplug for 20 minutes, sit outside on the porch with the sun, let the sun hit you, and just get off of that for 2 times 20. I mean, that's a great idea. I love that idea.
100%. And if you can't find 20 minutes in a day, then you're doing something wrong.
Oh, that's right. I totally agree with that. Right.
Soak up that vitamin D3, baby. You're in St. Augustine, Gino. Right. You got another week.
That's
right.
That's right.
What? So this is going to be kind of a tricky question, but what is the biggest and best mistake that you've made in the business? Where you really learned something?
So biggest and best is good. That's different than biggest and worst. All right. So biggest and best was probably that 100-unit deal. Because it's a good mistake. We're able to come out on top of it, but it was a mistake in that it's just not our profile. But we got great experience from it, and we learned a ton from it. First mistake was just varying strategies.
What did you really learn from that deal? That was it mostly helping you learn what your niche was?
Yes.
Yeah.
Because after that, we went straight into a pretty much bombshell of a 280-unit deal. That changed our entire business.
You mentioned the one thing from Gary Keller earlier. Is that your favorite book, or is there another book you'd like to throw out there for people to check out?
So business-wise, definitely Gary Keller, the one thing. But real estate, if somebody's looking for a good book to kind of get started and he flies under the radar with his books, is Jorge Perez, Powerhouse Principles. Gentleman who started the related companies. He's a Cuban immigrant. I mean, now he's a billionaire. But nobody even knows that he really wrote a book on real estate. But
I didn't either.
Gino's read like everything. You stumped the man over here. He's read every book, so this is good.
Yep.
Well, unfortunately, a lot of the real estate books are just, churning the same stuff, and they're all lead magnets now. They're all trying to sell something, and there's not much meat. That's why we live our profits, Jake. We kick ass there because we bring a lot of actionable content. A lot of these guys have great principles, but they just give you a little bit, and they're just teasing you. So when you find these books like that, I mean, it's always about why. We know the why. I want to know how to do it.
Yeah.
So
what was the title of that book?
Powerhouse Principles.
Powerhouse Principles. Check it out.
Jorge Perez. It's an easy read, but he tells his story, and it gets. I need an easy
read. Okay.
Yeah.
What was your best deal and why?
Best deal was that 280-unit deal. Not so much from economics. We did great on the economics of it, but we bought a 280-unit in Charleston, South Carolina. We went from the 100-unit to this deal. And it was a highly, highly distressed deal that we had a lead on. We learned the market for a year. And when it came up, we were prepared. We had the right combination of equity. We had the right knowledge of the market. And we had no business winning that deal. It was a function of timing. It was back in 2014. So the world was still a little bit coming out of the bottom, which was great. But Charleston was nowhere near what it is today. We got in way ahead of the curve there at a tremendous basis and executed a massive, massive reposition.
And then it turned quickly, didn't it? Probably like 2015, 2016, the place was rocking, right?
And the reason that deal, not only it legitimized us in the broker community, it got us into Charleston, which led to 3 additional deals within 18 months that, outside of institutional money, was impossible to do. I don't even know if anybody else did that without buying a portfolio at an institutional level, which then resulted in the best deal that we've ever done since we started this business.
What was the price per unit on that?
What was that?
No, I was just wondering, that first Charleston deal, what was the price per unit on it? Because you said it was pretty much vacant, right?
It was about 75% occupied, but drugs, guns, hookers. It was the place that everybody that got denied from everywhere else went to live there. Major disrepair. We bought it for $27,000 a unit.
Nice.
And we put in about another $2.2 million. We were all in for about 33 a unit, and we sold it for 45 in just 3 years on the nose.
Very good.
Wow, really good.
What project are you excited about right now?
The one we just closed. So the last few deals we've been doing, I've been getting more and more deeper into the rehab side. So I ultimately, one of my life goals, bucket list, I want to build something. I love it. So every job that we're doing now, I'm looking for like the heavy rehab where I can kind of use my vision, my passion. And we just closed this past Friday on the vacant 140 unit deal in Atlanta. So I'm able to finally go in and do everything because of the basis that we're buying the deal at that I've always wanted to do. From the granite to picking out the right cabinets to the right colors to windows to roofing to amenity packages to new parking lots. and really take this thing from a major disrepair and eyesore to a really functional, B community within its submarket. And it gets us into Atlanta, a market that we've spent a year almost going down there consistently to learn because it's such a big beast. So.
And that type of B product is in big demand right now, and because you can't really build it, so doing what you're doing is going to be really successful. I have a feeling.
Chris, how did you finance it? You just bought it all cash on the deal?
No, we have a great relationship with a bridge lender. So a combination of our private investors, equity, and bridge financing. So we were able to get we bought the deal for about $5.4 million. We're putting in another 4.3 plus operation, working capital. We're probably in for another $5 million, and we got an $8 million loan. It's a construction loan. They don't fund it all up front. They fund it like 3.2 up front, and then we draw down the rest as we need it at LIBOR plus 600. So interest only for 3 years.
So what'll your total cost per unit be on that once you're done?
We have a not to exceed at all costs of 80,000 unit.
And it's gonna be basically brand new.
All brand new product, and that's the mindset that we're taking.
That's great. No, that'll be good.
So if the market changes and we have to, we're at every deal that we're buying and looking at now, the last question is, if we have to hold this deal for the next 7 to 10 years, is this a deal we want to hold? And is it in a market and sub-market that we want to be in for the next 7 to 10 years?
What do you project rents to be on this?
We're looking to hit an average rent of about $10.50 on it.
That makes sense. That's good.
The floor plans are phenomenal. They're, I think we have like 30 some odd one beds, probably about 80 2 bed, 2 bath. They're all 2 bed, 2 bath, and then the balance 3 bed, 2 bath. But the square footage on the 2s and 3s are between 1,000 and 1,300 square feet.
And I'm guessing you're gonna have washer dryer hookups in these.
Every single unit, even our 1 bedrooms, we're getting stackables in.
That's going to be huge because everybody wants washer dryer hookups right now. So that's the biggest request we get on a daily basis. So.
Yep.
That's great.
What's the best way for listeners to get a hold of you?
Our website. We've spent a lot of time and energy over the last, Rebecca has spent a lot of time and energy. www.urscapitalpartners.com. We put a lot of great content up there. You can get signed up on there. We have an awesome investor portal. Once you get registered on our site, we post all of our deals up there. Once they're launched, if you're an accredited investor, kind of can click right through. And we're happy to also, we take a lot of pride in knowing our investors and understanding what their goals are because of the different types of deals that we do. We want to understand what people want, whether it's immediate cash flow, more upside driven, short-term, long-term. So we do a lot of kind of upfront, just consultation type of stuff with our investors. And that's a way you can get us on there.
Pretty good. Gino, you got anything else?
No, I'm just excited that I finally met Chris. I've seen the track. I think it's great how he's evolved from, Crackden, Patterson, or I should say the heroin capital of the world, all the way down south.
We all started
Charleston.
the Crackden, right?
And Jake, the great thing about it is you always hear people say, how big should I go? Well, he went from a 100-unit problem to a massive 280 units. So, I mean, people are complaining about a 10, 12 unit. He just made a massive, huge leap. I mean, it's like buying 100 units on your first deal, what he did. So I commend him for that. So I'm really glad we had him on the show today. I'm just like to keep the relationship going and, stay plugged in.
No, it's always great to get on with a couple of New York guys that are making it happen. So I think your guys' story is phenomenal, and it's been awesome to watch you guys grow too. So definitely want to keep the dialogue going.
Thanks.
All right, thanks, guys.
All right, thank you.